Warren Buffett's net worth is $100 billion. He's the richest person in the world right now. What's remarkable is not that he's rich. What's remarkable is that 99% of that wealth was accumulated after he turned 50. He wasn't even a millionaire until he was in his late 30s. This is not a story about an exceptional investor in his prime. This is a story about time, reinvestment, and the power of compound interest at scale. Warren Buffett's wealth path is different from most billionaires. He didn't found a company that went public and made him instantly rich. He didn't invent a technology that disrupted an industry. He didn't inherit a fortune. He built wealth through boring, disciplined, long-term thinking. And the math of his wealth is far more instructive than the media narrative. The media tells you that Warren Buffett is a brilliant stock picker. The media tells you that his edge is his ability to see companies that others miss. The media tells you to learn his principles and you can replicate his returns. All of this is true. But there's another story in the numbers that nobody talks about. The real lesson from Warren Buffett's life is not about stock picking, it's about time. Warren Edward Buffett was born in 1930. His financial journey started remarkably early. At age 11, he bought his first stock. It was Citi's Service Preferred stock at $38 per share. He pooled his savings with his sister to buy it. The stock fell to $27. Then it rose to $40. He sold at $40, profiting $5 per share. Later, the stock shot to $200. He learned a hard lesson about patience. He sold too early. But he didn't stop. He was obsessed with business and investing. By the time he was 14, he had already read every book in his public library about investing. By age 15, he had earned $1,000 from paper routes and various businesses. He invested that money in farmland that rented for $35 per month. In 1947, at just 17, he filed a tax return and claimed farming as his occupation. By age 21, he had accumulated $5,000. That's roughly $65,000 in today's money. Not a fortune, but significant capital accumulated through a teenage job and disciplined saving. He then went to the University of Nebraska, studied business, and graduated in 3 years. In 1950, he discovered Benjamin Graham's book, The Intelligent Investor. He was 19 years old, and this book changed his entire investment philosophy. He moved to New York to study under Graham at Columbia Business School. Graham's philosophy was simple. Find stocks trading below their intrinsic value and buy them with a margin of safety. Don't speculate, don't chase trends. Buy good businesses when they're cheap. Buffett worked for Graham Newman Corporation and earns $12,000 per year. That was exceptional income in 1950. He saved aggressively. By age 30, he had accumulated roughly $140,000. He was on the path to wealth, but he wasn't yet rich. Then, in 1956, he returned to his hometown of Omaha, Nebraska. He was 25 years old. He started investing other people's money. This is the crucial turn. In 1956, Buffett started a partnership with 7 investors, including his sister. He raised $100,000. His contribution was $40,000. He charged his investors a standard fee, 4% of profits and 25% of gains above the return of the Dow Jones Industrial Average. From 1957 to 1968, his partnership returned 2,610%, while the S&P 500 returned 316%. He was crushing the market. By 1969, his partnership had $100 million in assets under management. But in 1969, Buffett did something unusual. He dissolved the partnership. The market was expensive. Stocks were overvalued. He told his investors, "I do not want to operate when current conditions make it mechanically difficult to use sound investment judgment." Most investors in 2022 could have benefited from that same discipline. Buffett kept some of his assets invested in Berkshire Hathaway, a failing textile manufacturer. His business partner, Charlie Munger, convinced him to buy the company and transform it into a holding company. In 1965, Berkshire Hathaway was trading at $7.60 per share. Buffett's partnership began buying shares. The textile business was declining. But Buffett realized the company had $30 million in cash. He could use that cash to buy other companies, and that's exactly what he did. By 1967, he had bought National Indemnity Company, an insurance business. The insurance business was revolutionary for Berkshire because insurance companies take in premiums immediately but pay claims years later. That float, as Buffett calls it, gives you free money to invest. It's the ideal business model if you're disciplined about underwriting. From 1965 to today, Berkshire Hathaway has purchased dozens of companies. Geico, Nebraska Furniture Mart, Fruit of the Loom, See's Candies, and scores of other businesses. He's also built massive stock positions in American Express, Coca-Cola, and Apple. Here's the key number. From 1965 to 2024, Berkshire Hathaway stock has returned roughly 19.8% annually. That's 9.8 percentage points above the S&P 500 average. This is where the compound interest story gets remarkable. Buffett made his first million by age 30, roughly 13 million in today's money. By age 40, he was worth approximately 25 million. By age 50, he was worth approximately 375 million. By age 60, he was worth approximately 3 billion. By age 70, he was worth approximately 30 billion. By age 90, he was worth approximately $100 billion. The growth accelerated over time. From age 50 to 90, he accumulated $99.6 billion. That's 99% of his wealth generated in the 40 years after age 50. Why? Because the base was so large. When you're compounding $375 million at 19.8% annually, the dollar gains are enormous. A 19.8% return on $375 million is $74 million. That's more than many people make in a lifetime, every single year. Add to this the fact that Buffett reinvested every penny of earnings back into Berkshire Hathaway. He never spent the money. His salary is $100,000 per year. He lives in a modest house in Omaha that he bought in 1958 for $31,500. His car is not a Ferrari, he's not on yachts, he's compounding. This is the most important insight from Buffett's wealth. He understood that spending money on himself was the enemy of compounding. By reducing his personal consumption, he maximized the capital available to compound. Buffett's principles are well documented because he writes an annual letter to shareholders. Let's break down the core principles that actually generated the wealth. First principle, value investing. Buy companies trading below their intrinsic value. Calculate what a business is worth by looking at its earnings, cash flow, and competitive advantages. If you can buy it at a discount, you have a margin of safety. Most investors don't do this. They buy based on price momentum, media hype, or hot tips. Buffett buys based on fundamentals and patience. Second principle, long-term holding. Once you buy, you hold. Berkshire's average holding period for stocks is over 10 years.
Most investors hold stocks for less than 1 year. Buffett's philosophy is, if you can't hold a stock for 10 years, you shouldn't hold it for 10 minutes.
This principle has massive tax advantages. Long-term capital gains are taxed at 15 to 20%. Short-term gains are taxed as ordinary income at rates up to 37%. By holding long-term, Buffett reduced his tax burden dramatically. The difference between 37% and 15% on $1 million is $220,000. Over decades, this is billions of dollars. Third principle, reinvest dividends. When Coca-Cola pays a dividend, Buffett doesn't take the cash and spend it. He reinvests it to buy more Coca-Cola stock. The power of compounding works on dividends just as much as capital appreciation. Fourth principle, scale the capital. Once you've made money, you use that money to make more money. Buffett didn't just keep compounding on $40,000, he compounded on millions, then billions. The base gets larger, so each percentage point of return is worth more. Fifth principle, understand the business. Buffett doesn't invest in industries he doesn't understand. For decades, he avoided technology stocks because he didn't believe he understood them. Only recently, late in life, did he invest heavily in Apple. When he did, he understood exactly what he was buying. Sixth principle, patience. Buffett has sat on billions in cash, waiting for the right opportunity. After the 2008 financial crisis, he bought American Express at a discount. When COVID crashed the market in 2020, he started buying again. He doesn't try to time the market perfectly. He waits for moments when fear is highest and opportunities are clearest. Most people look at Warren Buffett and think, he's a genius investor. I can't replicate that. But the numbers tell a different story. His edge over the market was about 10% annually. That's roughly 2% better than the S&P 500 average. 2% doesn't sound like much. But over 70 years, 2% becomes the difference between a $100 billion fortune and a $15 billion fortune. Here's the remarkable thing. You don't need to beat the market by 2%. You just need to match the market. An S&P 500 index fund would have returned 10% annually. If Buffett had simply invested in an index fund at age 30 and never touched it, he would have had, let me calculate, $40,000 at 10% for 60 years equals approximately $2.5 billion. That's $2.5 billion without any special skill, just time and compound interest. The reason Buffett is worth $100 billion instead of $2.5 billion is not primarily because he's smarter. It's because he 1. Started early, age 11, 2. Committed capital, building to hundreds of millions by age 50, 3. Achieved above average returns, 2% better than the market, 4. Reinvested everything, never took capital out, 5. Had a long time horizon, 70 years of compounding. The first, fourth, and fifth points are not genius, they're discipline. Most people can replicate that, most people don't. The ones who do will end up far wealthier than the ones who don't. What can you learn from Buffett's actual track record? First lesson, start early. Buffett started at age 11. You might be 25, 35, or 45. That's fine, but don't wait until 55. Every year you wait costs you dramatically in the long term. Second lesson, choose an index fund. If Buffett had simply invested in an S&P 500 index fund instead of trying to beat the market, he would still be incredibly wealthy. Vanguard, Fidelity and Schwab all offer index funds with expense ratios under 0.05%. You're not trying to beat the market like Buffett did, you're trying to match it while you sleep. Third lesson, reinvest everything. When your stocks pay dividends, reinvest them. When you have capital gains, reinvest them. Buffett's wealth accelerated because he never took money out. You don't need to match his returns, but match his discipline. Fourth lesson, hold long term. Buffett holds Coca-Cola stock for decades. You don't need to wait decades, but holding for 5 to 10 years instead of 1 to 2 years dramatically changes your tax situation and your returns. Fifth lesson, build the base. At age 50, Buffett was worth $375 million. That large base compounded to $100 billion. You might be 50 and worth $500,000, or $1 million, or $2 million. That's your base. The question is, what will it compound to if you let it work for 40 years? Sixth lesson, save ruthlessly. Buffett's salary is $100,000 per year. He doesn't spend it. Most people earn far less and spend far more. If you want to build wealth, you have to reduce the gap between what you earn and what you spend. Here's the actual framework to build wealth like Buffett, not by beating the market, but by matching it with discipline. Step 1. Calculate your current capital. How much do you have saved? Be honest. If it's $5,000, that's your starting point. If it's $50,000, that's your starting point. If it's $500,000, that's your starting point. This is your base. This is what will compound. Step 2. Calculate how much you can add annually. If you earn $50,000 per year, can you save $5,000 annually? If you earn $100,000, can you save $15,000? The percentage doesn't matter. The amount you save divided by what you earn is your savings rate. Buffett's savings rate has always been extremely high. Even now, when he's worth $100 billion, he saves aggressively. Step 3. Invested in an S&P 500 index fund. Don't try to pick stocks.
Don't try to beat the market, just match it. VTI, Vanguard Total Stock Market Index, VOO, Vanguard S&P 500 ETF, or SPY, Spider S&P 500 ETF, are all options. Pick one and stick with it. Step 4. Reinvest all dividends. Set your account to automatically reinvest dividends. Don't touch the money. This compounds your returns. Step 5. Check your balance once per year. Don't check it every day. Don't check it every month. Checking frequently creates the illusion that you need to do something. You don't. Let it work. Step 6. Project forward.
If you're 35 and you have $100,000 saved, and you can add $10,000 annually at 10% returns, you'll have approximately $1.2 million by age 65. That's not billions, but it's financial independence. It's the freedom to choose how you spend your time. Most people won't do this because it's boring. It's not exciting. It doesn't provide the dopamine hit of trading stocks or chasing hot sectors. But boring is exactly why it works. Warren Buffett's $100 billion fortune is remarkable. But the remarkable part is not that he built it. The remarkable part is that anyone with discipline and time could do something similar, even if they only matched the market instead of beating it. The numbers show that 99% of his wealth came after age 50. Not because he was smarter in his later years, but because the base was larger and compound interest is exponential, not linear. You're not going to be the next Warren Buffett by picking the next Apple or discovering the next Microsoft. You're going to build wealth by starting early, saving consistently, investing in index funds, and letting time work.
This is what they don't teach you about money. The path to wealth is not glamorous, it's systematic. The question for you is this: will you replicate Buffett's discipline, even if you don't replicate his returns? Because discipline plus time plus compound interest is the formula that works. Everything else is speculation.